Yakuta, guys, some of you can't hear me, so I'm not sure if this is. Just leave a green check if you can hear me. Okay, so it seems that some of you have a problem, not all of you. Okay. Question number 1. The answer is A. When receiving cash from customers, that will have no effect on total assets. Why? When receive cash from customers, cash increase and account receivable decrease. So the effect was both in the account. So when I receive cash from customer on account, so the effect will be like that. Cash increase and account receivable decrease. Both of them are in the assets, so that will make them a 0. So that means we don't have an effect on the total assets. So the first one should be A, have no effect on the total assets. Is this making sense to you? Okay. 2, it should be D. The effect of paying salaries for the current period is when I pay salaries, cash decrease, so assets decrease, and shareholders decrease because of expenses. You know that salaries is an expenses, so expenses decrease the retained earnings, which is under the equity. So that means that will decrease the assets and decrease the shareholders' equity as well. Okay, as long as I don't see any red cross, that means you agree with me, so I will continue. Okay, perfect. Question 3, it's C. Debit entry to an account always increase assets, because liabilities increase will be in the credit side, equity increase that will be in the credit side, so debit is always increasing assets. So the answer should be C. The last question. Can you explain number 3 again? You mean this one? Debit. When you put any debit entry, if I need to increase liability, I will put the liabilities in the credit side, not the debit side. If I want to increase equity, I will put it in the credit side, not the debit side. The only ones that I can increase it by the debit side is assets. So that's why I have to, debit entry will increase to an account, increase assets only. Okay, this one has some mistakes. Number 1, they give me a trial balance and they asked me to prepare a correct trial balance. And they said that assuming all accounts have normal balances, that means assets is normally in the debit, liabilities normally in the credit, equity and is normally in the credit side, revenue credit, expenses debit, dividends debit. So that means they messed up in the debit and the credit. So I need to put them in the right one, and they are not in the right order. They like make it randomly. So I have to make sure that they are in the right order as well. What are the right order? So in order to solve this correctly, so I have to make sure that I know that assets normally in the debit side, liabilities normally in the debit side, common shares credit side, retained earnings credit side, revenue credit, expenses, debit, dividends, debit. So these are the normal balances. So if I don't see them in the right order, in the right place, I have to correct them. Plus, I need to make sure that they are in the right order. What is the right order of the trial balance? Assets, liabilities, common shares, retained earnings, dividends, revenue, and then expenses. So this is the answer of the question, to make sure that the debit and credit are correct. And then I have to do that in the order that's right order. Asset, liability, common share, retained earning, dividends, revenue, and expense. Okay, so back to the question. Liabilities normally credit. Do you remember? Okay, you did not. So please make sure that you know the debit and credits very well in the weekend guides. This is very important. Everything is built on that. Assets debit, liabilities credit, common shares credit. Do you remember the accounting equation? Left side is debit, right side is credit. So the answer will be like that. Number one, as you can see, I've started with listing the assets. Cash, accounts receivable, supplies, prepaid insurance are assets. So all the assets will be in the debit side. So they started with the assets, and assets normally in the debit side. Then I will move to the liabilities. Accounts payable, salaries payable, unearned revenue is a liability. Actually, this is the only liability without the word payable. Unearned revenue, as I wrote in the slides, unearned revenue when the company receive cash in advance. So it owes the service or the product to the customers. So they have an obligation to provide the service and the products to the customers. So it is a kind of a liability. So I started with the asset then liability, and all the liabilities should be in the credit side. So they list all the liabilities in the credit side. So this is assets and this is liability. Then, so the trial balance, I have to list assets, then liabilities. Assets normally in the debit side, so I list them all in the debit side. Then I started with the liability, which is accounts payable, salaries payable, unearned service revenue, which is considered as a liability. Unearned service revenue, this is when the company receive cash before providing the service. So the company owes the service to the customer. So for example, if there's an iPhone, a new iPhone is coming up. So you went to Apple and you want to be the first one who got the product. So you pay in advance to the company like a down payment or the price of the product in advance. So Apple will say that this money is not revenue yet because we did not give the product to the customer yet. So this money will be recorded as a liability. Why? Because we have an obligation to give the product to the customer. So we're going to record the money that we received in advance as a liability, which they name it unearned revenue. So unearned revenue is a liability. That's why I put them under the liabilities in the credit side. Then I put the common shares. Then I put the dividends and the retained earnings. Actually, the retained earnings in some problems they put it before the dividends. So if the book put it like that, I will accept both of them. But most of the books put the retained earning and then the dividends. So I will accept both of them. Dividends will be in the debit side, retained earning in the credit side, then revenue, and then expenses. Revenue, credit side, and expenses debit side. Make sense? Raise your hands if you're following, please. So this one tests your knowledge about the debit and credit. Common stock is credit side. So common stock is the 10,000, which is in the credit side. It seemed that I did a mistake in the slide in the 10. Let me see. Oh, sorry. Liabilities is credit. Yeah, no, you're correct. It seemed that I started to be tired. So liabilities is credit. Yeah, you're right. I'm sorry. Okay, any questions? Okay, you're good? Okay, let's move on to the step. Can you repeat what common stock is the shares, the common shares. Shares or stock, they are the same meaning. So sometimes we name it common stock or sometimes we name it common shares. So stock and shares means the stocks that we sold in the stock market or the share that we sold in the stock market. And it is in the credit side. It is the capital. Okay. Any other questions before moving on? Okay, let me start recording the part 2 of this class. Okay. After so far we took the first 4 steps: analyzing, journalized, then posting, and the trial balance. I'm going to leave step number 5 and 6 for the next class, which we're going to do what we name it adjusting entries and the adjusted trial balance. Then we're going to continue to step number 7. So step 5 and 6 for now. Then we're going to jump to step number 7, which is preparing the financial statements. Actually, we talked about the financial statements in the first class, but we're going to explain in more details now and give you some additional information. So as you know, we have 4 financial statements and they have to be prepared in this order. We have to start with the income statement, and sometimes we name it statement of earnings, then the statement of retained earnings, then the balance sheet, or sometimes we name it statement of financial position, and then the cash flow statement. The cash flow statement will be taken in the last chapter of this course, so don't worry about it now. So we have to make sure that we can prepare these 3 financial statements: income statement, statement of retained earning, and the balance sheet or the statement of the financial position. Okay, so now we're going to move into the income statement. The income statement, there is 2 ways to calculate the income statement. So what are these two ways? There is one called a single step way, and the other one is the multi-step way. In the single step way, this is the simple one. And in the exam, I'm going to tell you whether to follow a single step or a multi-step. So for the single step, let me change the font a little bit. In the single step, this is the easy one. All what you're going to do is you start with after you put the heading, if you remember what is the heading, you put the name of the company, you put the name of the statement of earnings, and the date for the year or the months ended. It depends on when we're preparing our financial statement. It can be for the months or for the year ended and then the date. For the single step, you start with revenue and you list all the kind of revenue that you have. Then you deduct all the expenses except the income tax expense. And you get income before tax. So revenue minus all expenses except the income tax expense, you got income before tax. Then minus income tax expense, you got your net income. In the textbook, they put the income tax expense with all the expenses, but please follow this format, not the one in the textbook. So in the single step, you start with the revenue, then you deduct the expenses, and in this expenses, you list all the expenses except the income tax expense, and you got income before tax minus income tax expense, you got your net income. Okay. I need you in the slide that I posted under the in-class problem solving. I think at the beginning you have the unadjusted trial balance for Rogers. This is the one that I'm going to use in order to prepare the financial statements. So please make sure that you can access the in-class problem solving lecture 2. At the beginning, you're going to find this slide. Which I'm going to use in all the financial in the preparation of the financial statements. Can you see it? Okay. It is in the problem solving. It is, I think it is the first slide in the in-class problem solving lecture 2. If you can find it, just make the green text so I know that you can see it. No? Okay, let me open the... I'm trying to open the Learn. Oh, it seemed that the total expenses, which is the 22,050, I got what we name it income before tax, which is the 7,950. So this is revenue minus the total expenses. I don't have income tax expense, that's why I put it at 0. Sometimes they will give you the income tax expense as a percentage. So for example, we're going to tell you that the tax expense is equal to 10%. So if you have it like that, to calculate the income tax expense, if you have income tax expense will equal to income before tax multiplied by the tax rate. But I don't have this in this problems. That's why I put the income tax expense equals 0. But if you have a tax rate, then you're going to multiply the tax rate by the income before tax. You got your income tax expense. But here I have it 0, so I got then the net income. So this is called a single step. You just make the revenue minus all the expenses. You got income before tax minus tax in a separate line. And if you can calculate it, that will be how to calculate it. Income before tax multiplied by the tax rate, you got your net income. Make sense? Raise your hands if you're following, please. Okay. Let's move to the multi-step. Multi-step is like having the net income, but but when we present the income statement, it will be different. It has more than one step. So let me here explain to you the steps, then apply it on the same question. So multi-step. Multi-step income statement. If it is calling multi-step, that means that it includes more than one step that I have to do in order to arrive to the income statement, to the net income. So I will do each step with a different color, so it will make it easier for you to study. So the first step, I will start with the sales revenue. This revenue that I got from selling the inventory. That's why I name it sales revenue. Only the sales revenue, less or minus the expense related to the inventory, which is the cost of goods sold. So sales revenue minus cost of goods sold, you got what we name it gross margin, and sometimes we name it gross profit. And this is step one. So step one, you start by the revenue that come from selling inventory, which we name it sales revenue, minus the expense related to inventory, which is the cost of goods sold. You got what we name it gross profit or gross margin. This is step number one. Step number two, you start by what you list what we name it operating expenses. So gross profit minus what we name it operating expenses. What are the operating expenses? Operating expenses, you list all expenses except income interest expense and income tax expense. So any other expense will be listed here. Rent expense, depreciation expense, salaries expense, and advertisement expense, any expense except interest and tax. So gross margin minus operating expenses, you got what we name it operating income. And this is step two. So step one, you calculate the gross margin by deducting the cost of sales revenue minus cost of goods sold. Then step two, calculate the net income, the operating income, which is gross margin minus operating expense. You got your operating income. Excuse my misspelling. Income is wrong, so I'm sorry. Okay. Then step number three, after that, you deduct what we name it non-operating items. And in this section, we list all the expenses that is not operating. So for example, I will deduct the interest expense. Also, in this section, I'm going to put any other kind of revenue other than sales revenue. So for example, if I have a rent revenue, I rented my warehouse and this has got me a revenue. So this is the place where I should put this kind of revenue. So I list any revenue other than the sales revenue. Revenue would be added because this will increase my income. Also, if I have any gain For example, I sold my equipment with a gain. So for example, gain from sale of assets. This is the place that I'm going to put the gain. And also it will be plus because it will increase my net income. Also, if I have a loss, for example, I had a fire and I had a loss because of this fire. So here I have to put how much I lost in this section, which we name it non-operating items. Loss will decrease my income. That's why I make it with minus. So in this section, I put all the items that is not operating. So interest expense, will be minus. If I have a revenue or gain, it will be plus. If I have a loss, it will be a minus. This section could have a positive amount or a negative amount, Alex, depending on how much you have, whether the expenses and losses is more than the gain in revenue or the opposite. So I'm not sure what would be the number here. But what you have here would be deducted from the operating income or added to the operating income. So here I can make less or this can be less or add depending on what we have in this section. So operating income plus operating item or minus operating item depending on how much we have here, you get what we name it income before tax. And this is step 3. Last step, let me choose a different color. Minus income tax expense. And we agreed this is equal to, sometimes I have to calculate that. You got your net income or your net loss, depending on the number that you have. So this is called a multi-step income statement. As you can see, you have 4 steps or 3 steps until you arrive to the net income. First, you have to calculate the gross margin, then the operating income, then the income before tax, and then you arrive to your net income in the last step. Here, this was the last step, which is step 4. Okay? Let me put some numbers here, depending on the slide that you had. If you're done writing, please put the green check. If you still want to still writing, make a red cross. What is the rent revenue? For example, if you have a warehouse in your company that you rent it to others, so that's what we name it, a rent revenue. So the money that you get from the rent, it's a revenue for your company. So that's why we name it rent revenue. Okay. So now I'm going to repeat this, but I'm going to use the numbers from the slide that you have. So keep an eye on that one in order to know how I'm going to put some numbers. Okay, are you done writing? Gain from sale of assets, if you have a machine, for example, or an equipment and you sold it to others and you sold it with gain. So that's called a gain from sale of assets. Okay, so I need you to look at the slide that you had before, and I'm going to prepare the multi-step income statement. So I will start with the name of the company. We're talking about Rogers Company. And I'm going to prepare income statement or statement of earning for the month ended July 31, 2017. Then I will start with the sales revenue. In this question, the sales revenue was $30,000. So I will write here $30,000. Then I will start with deducting the cost of goods sold. So less cost of goods sold. Any number that I'm going to deduct, I will put it between two brackets. So cost of goods sold was 18,000. I put minus 18,000. So 30,000 minus 18,000, that will give me the gross margin, which is 12,000. So gross margin, and this is 12,000. So I'm done with step number 1. I calculated my gross margin by deducting cost of goods sold from sales revenue. Then I'm going to deduct the operating expenses. And in this section, I'm going to list all the expenses except tax and interest. So if you look at the list, I will take every kind of expense except interest and tax. So I have rent expense for 2,000. I have depreciation expense for 1,000. I have insurance expense for 300. I have bad debt expense for 500. And that's it. I will not take the interest. So this is all the expenses that I have. So I will add this section, 2,000 plus 1,000 plus 300 plus 500. I'm going to get here 3,800. So this is the total number of operating expenses. So I'm going to gross margin minus the operating expenses. I'm going to get 8,200. And the 8,200 is called operating income. And this is step number 2. So I prepared the first step, which is the gross margin. I deducted all the expenses that I had except the interest expense and tax. I named that under the title operating expenses. Gross margin minus total operating expenses, I got the operating income. Income statement can be prepared monthly or annually, depending on what the company wants. And the Rogers, they prepare it on a monthly basis. And I think it was June, not July. I think I made a mistake here. I'm not sure if it's July or June. I don't want to go back and forth, but I will check if it is July or June. Okay? Is the first 2 steps okay with you now? Yeah, you can put it. No problem. Okay. Then I will start with step number 3. Let me choose a different color so you can easily spot what I'm doing. In the second part, I'm going to list the non-operating items. I'm going to check for first thing that I have to put if I have interest expense, which I have. So I will put interest expense, and interest expense is equal to 250. I will check if I have any kind of revenue other than the sales revenue, which I don't have. I'm going to check if I have any gain or loss, which I don't have. So the only operating item that I have is the interest expense. So I'm going to do the operating income, which is the 8,200 minus the interest expense. I'm going to get 7,950, and this is called non-income before tax 7,950. Then I will deduct income tax expense, which I don't have. So let me write it as a 0. So I got my net income equal to 7,950. So this is a multi-step income statement. Please make sure that you understand how to calculate each part. Sometimes the question asks you calculate the operating income. So you need to know that the operating income is equal to the gross margin minus operating expenses. So make sure that you understand how to do each step and what will be included exactly under each step. Okay? Raise your hands if you got the multi-step income statement. Okay, do you have any question before moving to the balance sheet? Okay, perfect. The balance sheet is my next, the statement of retained earning is my next statement. And we got this before, so it's easy. The statement of retained earning, you start with the beginning retained earning plus net income. I got this number from the statement of earnings or the income statement minus dividends. I got my ending retained earnings. So this is a simple statement. So if I need to do that, I'm going to use the statement that I have. I don't have any begin retained earning. There is no retained earning in my trial balance. That means there's no beginning retained earnings. This is the net income that I calculated from my income statement. It is given that the dividends equal to 2,000. So I got my ending retained earning equal to 5,950. So beginning retained earning plus net income minus dividends, you got your ending retained earnings. And don't forget to write the heading, the name of the company, the name of the statement for the months ended June 30. I think this is an easy statement. Okay? Any questions? Okay. Let's move to the balance sheet. And we took the balance sheet, which is assets equal liabilities from liabilities plus equity, but we're going to talk about the classified balance sheet. So we're going to make some classification within the balance sheet. You calculate net income with the formula. No, the net income, I took this number from the income statement. So remember when we calculate the multi-step, for example? No. The one that we had before, I'm not sure which state. Where is my... So Lee, do you remember when you calculate this the income statement? Go back to your notes. You're going to find that the income statement is equal to 7,950. Okay. The balance sheet, we're going to do the classified balance sheet. What is the classified balance sheet? Under the assets, we're going to classify it whether it is a current assets, non-current assets, or intangible assets. The current assets are those assets that we expect to be used or converted into cash within the accounting period. What is the accounting period? It is up to the company. They can set the accounting period as 1 month, as Rogers, or they can set it as 1 year, or set it as a quarter. So it's totally up to the company how long the accounting period will be. So depending on the accounting period, if the assets will be used within the accounting period, then we're going to name that as a current assets. So cash is a current assets because most of the time we're going to use the cash within the current period. Accounts receivable is a current assets because when we sold the products to the customers, we expect them to pay us within with this year, not next year. So that's why we name that as current assets. Inventory, if we're a good company, we expect to sell all the inventory that we own in the warehouse within the accounting period, within the current year. So the current assets are those assets that will be sold or consumed into or transferred into cash during the current year. On the other hand, the non-current assets are the assets that we expect to use for a longer than 1 year. So for example, when we buy a building, we expect to keep using the building for the coming 10 or 15 years. Machines, computers, equipment, car, trucks are all examples of a non-current assets because we're expecting to use that in more than 1 year. So we name that a non-current assets. The last classification of the intangible assets is the intangible assets. This is when we're talking about an asset that does not have a physical existence, like for example a trademark or a copyright. This is something the company owns and it has a value, but it does not have a physical existence. We name that intangible assets. So in the balance sheet, you're going to classify your assets under current assets, non-current assets, or intangible assets. Okay, my slides disappeared. Okay, that's weird. Yeah. I don't know why the liabilities slide is a blank one. This is weird. But for the liabilities, we classify liabilities. So I will write here. I don't know why I have a blank slide. You can see it. I don't see it. That's weird. It's not blank for us. It's blank for me, guys. Okay, so you can follow me. Liabilities can be classified as a current or non-current. So current liabilities is the liabilities that we expect to pay within the current year. Non-current liabilities, the one that I'm going to pay in a period more than 1 year. So by default, bonds payable and notes payable are non-current liabilities, unless other than that was told in the question. So by default, we say that accounts payable, salaries payable, interest payable, all of these we expect to be paid within the current year. But notes payable, bonds payable take longer time to be paid. So unless other than that was mentioned in the question, we consider the long-term, the bonds and the notes payable as a long-term liabilities. So this is how it looks, the assets, current and non-current, liability, current and non-current, then the shareholders' equity. There's a ratio that's called a working capital ratio. If you deduct the current asset minus current liability, you get what we name it a working capital. So if we apply this on Rogers, so I write Rogers Company balance sheet. Balance sheet is the only statement that we write the date at. We don't write it for the year or for the months ended, but we write it at. So we started to classify the current assets. We should start with the order with the one that's the least, the more liquid one. So cash is the one that we have already in cash, then account receivable, inventory, and prepaid insurance. All of these expect to be used within before the coming year. Then the liabilities. So I have then the non-current assets. I have equipment. Take care, remember the contra asset account, which is the accumulated depreciation. it will always be with minus. So remember, if you have an accumulated depreciation, that will be always with minus. Then you add the total assets, the current and the non-current. Then you less the current liability. I'm not sure if notes payable may be or may not. By default, notes payable and bonds payable are non-current liability, unless other than that was mentioned. Non-current liability, I have the bonds payable. Shareholders' equity, I have the common shares and the retained earnings. Take care that the retained earnings is the ending retained earnings that we got from the statement of the retained earnings. So this number is the number that I got from the statement of the retained earnings. Total assets should equal to total liabilities plus equity. Okay, is this making sense to you guys? Are you still awake? Perfect. I know I already started to I'm doing my best to be awake. You are the one who are lying on your beds now and maybe like are comfortable, but I'm the one who are talking, so I'm trying. But we have to finish. Other than that, I will let you study that by yourself, which I hate. Okay? But not going to be okay. Give me like 20 minutes and we're done. I will answer Jazz's question and then I will go to the last part. Jazz, income statement is the step number 7. We skipped 2 steps that we're going to cover next class, which is the adjusting entry and the unadjusted trial balance. So in the step number 7, we prepare the all financial statements, which are balance sheet, income statement, and statement of retained earnings. Okay. Okay. So let me. Okay, the steps in our slides are missing the first one, so the numbers are wrong. Okay, so away from the analyzing, so we start with analyzing, then journalize, then posting, then adjusting entries that we're going to take next class, and adjusted trial balance, which we're going to take next class. Then step number 6 are financial statements, and financial statements that include all the financial statements. Okay, that and your notes is like the steps that we're going to do, but we can combine this in one step, which is preparing the financial statements. Okay, so I will update that in your slides and I will post on your notes the updated one, okay, to not be confused. So tomorrow I will update your slides with the order, the correct order. Okay, so let's continue in order to not waste any time, and I need to finish the last part, which I think I will continue next class. So now we're going to do the last 2 steps, or depending on the time, preparing the closing entries. What are the closing entries? So I think I will start it now, and then we're going to finish it next class. But let me introduce it because I'm already behind the schedule by far. So let me introduce that. Okay. So after I prepare the financial statements, I need to do what we name it closing. So there's 2 types of accounts. There's what we name it permanent accounts and temporary accounts. Permanent accounts means those accounts will last with the company from this year to the coming year until we get rid of them. So for example, assets are a permanent account. If I own a land, it will still in my company until I sell the land. So it will move with my balance sheet from one year to another. If I own a building, that will continue in my business until I get rid of it. The same of my liabilities. If I owe money to others, I have to be in my balance sheet until I paid my debt. So it is not because the year ended, I will not list the liabilities anymore. Liabilities will remain in my balance sheet until I paid them. So that's why we name that permanent accounts. Also, the equity is a permanent account. So what about the temporary accounts? Temporary accounts are accounts that has a temporary job. And actually, we're talking about the accounts affecting the retained earnings. What are the accounts affecting the retained earnings? Revenue, expenses, and dividends. Those accounts has one job. I will keep track of all my revenues, expenses, and dividends during the year, and then I will add their effect on the retained earning at the year end. So actually, after I know how much is my total revenue, how much is my total expenses and dividends, I don't need these accounts anymore. So after I move their effect to the retained earning, I need to remove them. I need to close them. So if I'm talking about closing entries, I'm talking about closing the temporary account. So which account we're going to close? We're going to close the temporary account, which are revenue, expense, and dividends. Okay, is this making sense to you so far? Raise your hands if you're following, please. Okay, so when I'm talking about closing entries, I'm going to close. That means I'm going to get rid at the year end. After I prepare my financial statements, there are some accounts that I don't need them anymore. What are the accounts? Are revenue, expense, and dividends. We're going to close them. So the only accounts that we're going to close are the temporary accounts. So we're going that when I have to prepare the closing entries, that means I need to remove the temporary accounts, which are revenue, expense, and dividends. Why we're going to close them? They did their job. I don't need them anymore. After I prepared the financial statements, I show their effects on the retained earning. I don't need them. So I'm going to clean up in order to be prepared for the next year. So when I ask you to prepare the closing entries, that means you're going to think of these three accounts only: revenue, expense, and dividends. Is this making sense? Yeah? Perfect. How to close? How I'm going to remove them? I cannot just cross them. I have to close them from the accounting way. What is the accounting way? I have to close them using the debit and credit. To close an account, we just put it in the opposite side. What do you mean by that? If the account is normally debit, if I put it in the credit side, that will be closing the account. If it was credit, I put it in the debit, that means I remove that. Okay? So how we're going to close that? So let's move it like that. Revenue. What is the normal place of revenue? Can you write in the chat? Normal place of revenue is credit. Right. So to close it, I have to put it in the debit side. So to close revenue, I'm going to put it in the debit side. To close any account, we have to put it on the opposite side. So revenue normally in the credit. To close it, I'm going to put it in the debit side. Expenses. Normal place of expenses is debit. So to close expenses, I'm going to put them in the credit. Dividends. Normal place, debit. So to close, it will be in the credit. Take a second and please take a look on what I wrote and make sure that it is making sense to you and you're comprehending that. And if you're ready to move on, just put a green text so I can continue. If you're still awake. Okay? I'm happy that you're awake. Oh, I'm not awake, by the way. So I have 10 minutes and I'm going to sleep while I'm still talking, so you're better than me. Perfect. Okay? Can I move on? Okay. I think I will need, okay, here. So let's start with revenue and expense. For revenue and expense, to close revenue and expense, that will take us 2 steps. To close revenue and expense, I'm going to do that through 2 steps are needed. Number 1, we're going to close revenue and expense and substitute them with an account that's called income summary. This income summary is very similar to the net income. So as if we have here like a box, and in this box I just put in it the revenue and I put in that expenses. So you know that revenue minus expenses is equal to net income. So as if I'm going to summarize that, I'm going to remove the revenue account, remove the expense account, and put the effect of the two as an income summary, which is very similar to the net income. So let's do that using the debit and credit. Let's start with the revenue. So close the revenue to income summary. So how am I going to do that? Remember here at the top here, to close revenue, we are going to put it in which side? Debit. So revenue is normally in the credit. Now I need to close it, so I'm going to debit revenue. By putting revenue in the debit side, there is nothing called revenue anymore because revenue was credit. Now it is debit, it becomes 0. On the other side, I'm going to put the newly created account, which is called income summary. So now I close the revenue and I put its effect in the new account, which we name it income summary. So to close the revenue, I put it in the opposite side. It is normally credit, I put it in the debit side. I put the effect, I substitute the revenue with a new account called income summary. Then I'm going to close the expense. How to do that? To close the expenses, I have to put it in the credit side. It is normally in the debit, so to close it, I'm going to put it in the credit side. So I'm going to credit expenses. And in the debit side, I'm going to put income summary. Okay? Let me repeat myself through an example. Okay? Yes, always income summary will be used. Let me repeat myself using the example. So, do you know the slide that I need you to look at, Roger's company? Please keep an eye on this one. So, okay? You're still here, right? Raise your hands if you're still here. Okay. Do you know the statement that I want you to look at? Okay. If you're still confused, I will repeat myself through numbers. So I want you to look at the Rogers Company adjusted trial balance, the one in the in-class problem solving, and follow me, please. So, whiteboard. So in this, I will start to close revenue. So to close revenue, in Rogers Company, you have revenue for 30,000. Can you see it? You have sales revenue for 30,000. To close revenue normally credit, I will debit revenue. So debit sales revenue, and the number was 30,000. In the credit side, I'm going to put the newly account that we created, which we called it income summary. And it is equal to the revenue, which is 30,000. So now I close the revenue and I put its effect in the income summary. Make sense? Can I move to the expenses? Okay, to close expenses. I have a lot of expenses. I have to close every one of them by its name. So expenses normally debit. I will close them. I put them in the credit one by one. So let's get rid of the first expense, which is the cost of goods sold. It is equal to 18,000. The second one is the rent expense. It is 2,000. Then I have depreciation expense. It is 1,000. Then I have insurance expense, which is 300. Then I have bad debt expense, which is 500. I have interest expense, which is 250. By putting all expenses in the credit side, I closed all of them. I have to put in the debit side the new account, which is the income summary. And debit equals credit, so I will add all the number here, and that will equal to my income summary, which is equal to 22 and 50. So this is, I close the revenue, I close the expenses, I put their effect in the income summary. Is this making sense to you guys? Raise your hands if you're following, please. Okay. Actually, it seemed that I'm going to be a little bit later than 4:45. Feel free if you want to leave. I keep recording and you can get back to the course later on. But I need to finish that today. So if I exceeded the time of the class, feel free to go. And I'm going to continue recording until I finish this part. Okay? This is step number 1. After that, I have to do step number 2. Step number 2 is to close the income summary to the retained earnings. Okay, I replaced the revenue and expense with the income summary. I need to replace the income summary to the retained earnings. So I need to know and make a T account to know what is the balance of my income summary in order to close it. So I will make a T account here, income summary. Then in the first account, the income summary was credit for 30,000, right? So here I will go to the credit side and write 30,000. In the second entry, I have income summary in the debit side for 22.50. So here I have 22.50. So now I can know what is the balance of my income summary. The balance will be in the bigger side. The bigger side is the credit side. And the value is the difference between the two, which is equal to 7,950. So now I need to close the income summary, which has a credit balance of 7,950. To close a balance, an account, I have to put it in the opposite side. So if the income summary is a credit, to close it, I need to put it in the debit side. So debit income summary for 7,950. So now I closed the income summary and I put its effect in the retained earnings. So I put in the opposite side the retained earnings for 7,950. Okay, I hope that's okay. Is this making sense? So to close the revenue expense, I make it in 2 steps. Number 1, I close the revenue. Number 2, I close the expenses to the income summary. Then I close the income summary by knowing its place, and then I closed it to the retained earnings. The last thing, so I'm done with the revenue and expense. So don't forget that I have to close the dividends. Actually, dividends is easy to close because I'm going to do it in 1 step. So to close dividends, I'm going to, dividends is normally in the debit. To close it, I'm going to put it in the credit. So I'm going to credit dividends. And in my example, dividends was 2,000. And on the debit side, I'm going to put the retained earnings. So it is closed directly to the retained earnings. So dividends is closed in 1 step by putting it in the opposite side and put the retained earnings in the debit side. Okay, guys? I can show you the last step, and if you want to stay with me, I will record that anyway. I'm going to solve one more question on this one, so because I don't have time to return to this back. So let me show you the last step, and then I'm going to solve one more question here. From where we got the 22,050, this is the number that I got it. It is the total of this credit side. So this is, I added the credit side, debit equal credit. So this is the sum of the other side. Got it? Okay. So let me share the last thing and then I will solve a problem and I will record that. The post-closing, after I finish the closing entry, I prepare what I name it after closing trial balance or post-closing trial balance. In the after closing trial balance, there will be this is a major mistake. So in the exam, if you make it after closing trial balance and you have revenue, expense, and dividends, a negative mark will be applied. Because after I removed, closing means that you removed it. So after you remove the revenue and expense and dividends, you cannot put them in the trial balance anymore. So in the after closing trial balance, there will be no temporary account. So no revenue, no expense, and no dividends because I closed them. And after closing trial balance, the retained earning will be the amount of the ending retained earnings. So they make sure that you recalculate the retained earnings and you show it in the after closing trial balance. Okay? This making sense to you guys? Raise your hands if you got 60% of the closing entries. Okay. Do do you want to try this? So this is the after closing trial balance. As you can see, it has assets and liabilities and common shares and retained earning. No revenue, no expenses, and the retained earning, this is the amount of the ending retained earnings. So this is what we name it, after closing trial balance. Because I believe in practicing, so I know that you're tired and I'm tired, but I can willing to stay 10 more minutes after. I will record that. I will not stop recording. So if you're tired, I totally understand. You can leave. But if you want to stay, I do like and advise that you can practice on the closing entries before leaving, so it will stuck in your mind. So I can give you just 5 minutes to try to do it by yourself, and I will redo this one more time. So can you please try yourself by doing the closing entries? But if you're tired, you feel free and you can go, and I will record the answers. What is the statement of SE? I don't know what do you mean by a statement of SE. Tomer, I don't know what do you mean by SE. Closing entry of the dividends, you just put the dividends in the opposite side. It's normally debit, so I put in the credit side, and the retained earning will be in the debit side. So always it will be like that for the dividends. You debit retained earning and you credit dividends. Guys, if you're done working on it, please put the green text so I can explain it. If you're still working, leave the red cross in front of your name. Yes, you add income tax expense with the expenses. You close all kind of expenses. You're welcome, Martin. Okay, are you done? I'm not sure what numbers you're writing. And mol and milus. I don't know what this number represent. What was the second point in step 9? I'm not sure, Tama, what you're talking about. Step 9 is the closing entries. Permanent accounts. There was temporary and permanent accounts, Tama. Okay, let me explain that. So this is the right answer. First of all, you close the sales revenue. So you debit sales revenue because revenue normally in the credit, so put in the debit side, and I credited income summary for the same number, which is 162,820. Okay. Then I close all the expenses by putting them in the credit side. So I close salaries expense, rent expense, utilities expense, supplies expense, income tax expense. When I add these, I got 129,473. That will be debited as an income summary. How many of you got the first two transactions correct? Raise your hands, please. Yay, that's good. After that, I have to close the income summary. So let me here do it in a way. So you do a T account for the income summary. And you know that the income summary in the first number was credited. So I'm going to credit here 162. Oh, you cannot see. So here I'm going to put 162,820 in the credit side. And in the debit side, I have 129,473. So my income summary will have a credit balance of 33347 because this side is bigger and the difference between the two. If my income summary has a credit balance of 3347 in the credit side, then when I close it, I will put it in the debit side. So we debit income summary and we credit retained earning. So here I'm done with the revenue and expenses. First, I close the revenue. Second, I close the expenses. Then I close the income summary that I created. How many of you got the third transaction correct? Good. No, Lee, you don't have to write the explanation. You don't have to write close in counts. Yeah, it is in the debit side. Miles, it's debit for, it's here, debit 433. Then the last entry to close the dividends. Dividends always in the credit side, and the debit, so when it closes in the credit side, then we debit retained earnings. Is anyone got the whole problem correct? Raise your hands, please. So you are going to get A+ in this course, huh? I hope so. Thank you so much. I will adjust the order of the steps to make it the same as I said in class in order to not confuse you. Please, please, please try to solve as much as you can in the weekend before coming to the next class. Other than that, you're going to have it to feel that it is very hard. But when you solve problems, I'm sure that the accounting will be easier for you. So please make sure that you solve questions and do your assignments during the weekend. Okay, have a good night, and I will stop recording and I can answer your questions. If you can unmute yourself, that would be easier for us to communicate. So what is the final answer? Nathan, there's no final answer. So you just do entries to close revenue, expense, income summary, and dividends. So there's no final answer in this kind of question. Shouldn't we subtract dividends from retained earning? We should do that in the statement of the retained earning annual. But here we're closing the dividends. So that's why dividends decreasing retained earning. That's why dividends retained earning in the debit side. That means retained earning is decreased. Retained earning is normally in the credit. When I put it in the debit side, that means it is decreased. I'm trying to follow the questions. I'm not sure if I missed any question. Guys, is it hard for you to unmute yourself and ask me better than that? Because I think I'm missing some questions. Okay, Anmol, I think I explained to you. Can you explain the last entry? Okay, the last entry, you have to close dividends. So dividends is normally in the debit. So to close it, you put it in the credit side and you debit the retained earning. So you remove the dividends by putting it in the credit side and you put the effect on the retained earnings. So debit retained earnings and credit dividends. See you next class, Kara. Go back to the question, okay? Why we use retained earnings here? The idea of the closing entries, we close the revenue, expense, and the dividends because we have to show their effect on one of the permanent account, which is the retained earning. So for the revenue expense, first we close them and add them to the income summary, and then the income summary is shown on the retained earnings. Dividends also affecting the retained earnings. So all the three temporary accounts has why we remove them, because we need to show their effects on the retained earnings and then remove them. That's why we use the retained earnings as the final destination of their effect. Have a good night, Alex.